Hi everyone, and we're here at Emergence 2025 Investment Conference here at Four Seasons Hotel, Sydney. Joining here today is Evan Thornley, co-founder and CEO of LongView. He'll also be our keynote speaker on day 2 of Emergence 2025. So hi Evan, thank you for granting us.
Thanks very much. Good to be here.
Let's talk about first the innovative solutions of LongView. So LongView has developed unique shared equity products like Buying Boost and Home Flex. Can you explain how these innovative solutions are disrupting traditional property investment models and creating value for both investors and homeowners?
Yeah, sure. Look, the key thing with residential property is you want to be exposed to really good quality assets. You want a diversified portfolio of those assets. And you want to somehow avoid the pitfalls of being a landlord investor with land tax and maintenance and all the other problems. So our business has been serving landlord investors for a decade. We're the top ranked rental property manager in the country. And we've seen all the problems people have investing in residential property. And then we've gone back to our Silicon Valley and McKinsey roots to invent a better way. And so what we do is co-invest in those properties with the homeowner. So these are good quality family homes, $2 million family homes in the better districts of Melbourne, Sydney and Brisbane. So that's a diversified portfolio of good quality, very low volatility assets. And then we've created an investment mechanism that allows you to invest in that portfolio of family homes in a unique way. So that allows you to get leverage without debt. I'll explain what I mean by that in a second, and land without land tax. And so if you invest in a diversified portfolio of quality family homes, and you have those two tailwinds backing you in, you can get to mid-teens returns without any debt in your capital stack, without any of the risk or cost or hassle or tax of being a landlord. So we're trying to deliver something that's in what I call the missing middle of most portfolios. How do you get those sort of mid-teens returns, but on a very low risk stack? And Australian Resi Property does that, and our co-investment with homeowners is a unique way to do that.
Okay, that's really an interesting investment opportunity. And of course, can you elaborate more on your data-driven approach? So LongView focuses on Rodwells, or robust older dwellings on well-located land. So how does this approach give LongView a competitive advantage in selecting high-growth properties?
Yeah, so look, the Australian residential property market is an $11 trillion asset class. And there's roughly $700 billion of capital growth every year. It's the biggest wealth engine in the country. That's bigger than the size of the federal government. That's 4.5 times the size of all the earnings of every company on the ASX combined. But the question is, which of those homes? And so our data science teams analysed 50 years of prices of every single property in Australia, one by one. And there is a smaller group, 1/6 of all the homes, still a huge number, about 1.5 million homes, that generate more than half of all the capital growth in this country, as it turns out. And they are what we call the Rodwells of Sydney, Melbourne and Brisbane. Robust older dwellings on well-located land, the quality family homes of Sydney, Melbourne and Brisbane. And, land appreciates, buildings depreciate. These homes that many of your audience, it's the type of home that we all live in, 70 to 80% of the value of those homes is actually the land underneath the home. And it's the land that appreciates in value. And so you want to be investing in high quality land that happens to have a house on it. And that's how you're going to get the strong capital growth. So we're investing in that 1/6 of the market that delivers half of all the capital growth.
That's really interesting approach. And let's talk about your fund. So your fund uniquely aligns investor and homeowner interests through shared equity. Can you elaborate on how this approach mitigates traditional investment risks and creates a win-win scenario?
Yeah, sure. So look, I should explain, when I say co-investing with homeowners, well, who are they and why do they want us to co-invest with them? So these are middle-class families in $2 million homes typically. They tend to be asset rich and cash poor. They tend to have a lot of wealth, but too much of their wealth is tied up in the equity in their family home and they can't use it. So they own small businesses, they want to invest in their business. They might want to be the bank of mum and dad for their kids. They might want to do some renovations to their home and not want to increase their mortgage payments to do that. They sadly may be going through a divorce and need to get some of the equity out so they can split the assets, but still leave one partner and the children in the family home. There's a lot of different reasons why people want access to their home equity, and that's what HomeFlex does for those clients. And we co-invest our fund in their homes. But the deal we do for them is quite unique. We give them an equity investment. We're not a lender. We're not charging them interest. We're not waiting for monthly repayments. We're an equity investor. We're getting a share of the value of their home as it rises. So our typical deal is we'll give you a check for 10% of the value of your home, and in exchange for that, we'd like a 1/3 share of the future capital growth. So what that means is our investors only ever make $1 if our client is making $2, because they're making 2/3 of their capital growth. We're making 1/3, so our interests are aligned, and yet we are getting effectively 3.3 times leverage on the underlying growth in their home. 33 for 10, right? So if the underlying home is growing at, say, the typical average 7% per annum, then our return is 3.3 times that. So that's a very powerful mechanism, and yet our interests are aligned with the homeowner. It's let's be in really good assets that have really strong capital growth, and we share the upside together. So because it's their principal place of residence, no one's paying land tax, so we're getting exposure to really high quality properties with a diversified portfolio, leverage without debt, land without land tax. That's how you get to mid-teens returns on a risk stack that normally you'd expect to get mid to high single-digit returns on.
It's really a very promising investment opportunity, and also for prospective founders. We want to know your investment strategy. So with Australia experiencing significant urban population concentration, how does LongView's investment strategy capitalize on demographic trends and land scarcity in major cities?
Yeah, and look, this is the unique thing about Australia. Look, the strategy that we've adopted, I mean, we made it up ourselves, but there's plenty of funds in the US that have got tens of thousands of homes, 17 to 19% returns, multi-billion-dollar books, securitizing the back end. This is a known thing, what we're doing. It's called the home equity investment sector. But Australia is arguably the best market in the world to do that, because we have the second highest level of capital growth in the world. And the reason we do is our unique demographics. So Australia has the second highest population growth rate in the world, and we cram the vast majority of that population growth into just 3 urban centres, Sydney, Melbourne and Brisbane. And what that means is, for the last 100 years, the value of well-located land in the suburbs of Sydney, Melbourne and Brisbane has been doubling in value every 8 years, because you're getting more and more people and the same amount of land. And so that's what drives our investment. It's not a complicated idea, and it's been happening for literally a century. So unless something changes, that investment thesis continues. And so our job is to get our investors exposure to well-located suburban land, dirt disguised as houses, as I call it, and so that's what drives our fund.
That's really an interesting insight. And how about your return projection? So the fund targets 14% net returns over a 10-year period. What key strategies and market insights underpin this ambitious yet structured return projection?
Yeah, so this is, as I say, I think this is what I hope people are looking for in what I call the missing middle of your portfolio. You know, you'll have a little bit of your portfolio in, if you wish, crypto or venture or other high-risk assets, hopefully high return. You'll have some of your money in cash and fixed income. But how do you get a portfolio that on average across the whole risk-adjusted returns of the portfolio is generating maybe mid-teens returns and building your wealth steadily over time? You need some assets in the middle, the missing middle. And, you know, if you can get an Australian residential property risk stack, unlevered, no debt, generating 14 or 15% returns, then I think that really meets that criteria. And so because of the unique mechanism, we can invest in a widely diversified portfolio. We've got 64 homes now worth over $100 million across Sydney, Melbourne and Brisbane, so very diversified, no concentration risk, no individual market concentration, no individual asset concentration, no leverage, so no debt, none of those risks. I mean, we're watching grass grow around these homes while they double in value every 10 years, and yet because of the mechanism I described, we can deliver mid-teens returns. So you know, I think that is a unique proposition.
So you mentioned earlier about the 64 properties that you have approved, and it is valued at approximately $104 million. What are your expansion plans, and how do you see the fund scaling over the next 3 to 5 years?
Oh, yeah, look, I mean, we're doing 5 or 6 a week right now at our investment committee. So, and we're getting most of those customers just through our own digital marketing funnels. There's just an enormous number of Australians, it turns out, who have a desire to get access to some of their home equity, and a subset of those happen to be in the type of homes that we're willing to invest in. But there's still, 1.5 million of those homes. So, look, I don't know what the total addressable market is here. What I do know is similar funds in the US have grown to tens of thousands of homes, multi-billion-dollar books, 17 to 19% returns. And Australia is a better market for this. So we know that there are tens, if not hundreds of thousands of families out there who want access to their equity. A portion of those are in the homes that we want to invest in. We seem to be discovering more and more of them every day. So we're pretty confident that we can, our first fund, we're looking to just put 200 homes together in a balanced portfolio. That'll be $40 or $50 million. We hope to have that away by the middle of the year. I expect our next fund will hopefully be a couple of $100 million, and then, hopefully growing on from there as has happened in the industry in the US.
Okay, that's fantastic. And lastly, we want to know your experience here at Emergence 2025. How has been your experience here so far?
Yeah, look, it's been fascinating. My personal experience, I put the first Australian tech company on NASDAQ, the first tech unicorn. So, believe me, I get tech, I get venture, I get risk. I was fortunate enough to be very successful in that. But I guess what I shared with people is I've also seen the downside of risk. And when you've worked so hard to make that money, sure, you might want to swing for the fences with a small proportion of your portfolio in some of those more exotic asset classes, and maybe you'll do very well, maybe you don't. But mainly what you want is a balance across your portfolio to make sure you're doing steady wealth accumulation. And so I think people here have found that an interesting counterpoint to, a bunch of very exciting, very interesting and somewhat more exotic asset classes. And we're just kind of straight down the middle of Main Street, quality family homes, but mid-teens returns. So I think that's resonating with people who want that sort of stable center to their portfolio, while they also consider, some more exciting and riskier opportunities.
Amazing. And I think that's it. So
Terrific.
Thank you so
Thank
much,
you-
Evan,
thank you
for
very
granting
much.
us this interview. And also to our viewers, thank you so much for watching. And I look forward to seeing you in my next interviews.